Welcome, everybody, and thanks for joining me for the next few minutes. 2020 was a unique year for life science and healthcare companies, to say the least. The COVID-19 pandemic forever altered the industry by spurring growth and innovation, ultimately leading to new capital opportunities. Over the next 10 to 15 minutes, I'm going to walk through some venture fundraising industry trends, insights into changes in debt markets, and a look at what to expect for venture capital in 2021. Overall, it was an amazing year for the life science and healthcare sector from a venture fundraising perspective, especially when you think back to last year when the lead of our team, Pamela Aldsworth, was doing the same presentation, and there was so much uncertainty leading into the pandemic, not really sure what was going to happen from a venture fundraising perspective, company formation, et cetera. As we look back on 2020, venture partners are busier than ever looking at deals, and every sector saw record investment in life science and healthcare. This first slide talks about total venture capital raised for all of 2020 and actually dates back to 2010. And what this shows is that we had a fourth straight record year for life science and healthcare, which reached 17 billion, which if you look at the 39 number there, that's total venture capital raised. So for life science and healthcare specifically, 17 billion of that was related to funds that were able to raise additional funds of finance. From a direct investment standpoint, into these healthcare companies, $52 billion was invested, a 50% increase over 2019. And if we look at which quarter was the most active, in Q3 of 2020, there was $15 billion invested into these portfolio companies. The next few slides, I'm going to dive a little deeper into each subsector. And what I would say is that when you look at the trends and you look at the data here, these are average funds raised versus kind of total funds or the median. So just please keep that in mind as you're looking at the data. But from a biotechnology standpoint, Series A investment grew year over year from both a dollar as well as a deal perspective. So really strong investment in biotech, which is pretty consistent with years past. We are seeing companies that are spending more time preclinical, getting investment earlier on in their life cycle, which is obviously providing a lot of investment year over year, as well as helping feed the IPO economy as well as exits there. So a lot of excitement on the biotech side. When we look at which indications these are going into, platform companies are still drawing a lot of interest, as well as oncology and neuro. And if we kind of looking back to the last slide a little bit around the venture funds that were raised, if we look at these VCs that raised funds in 2020, some of the notable ones are around Arch, Flagship, Deerfield, A16Z, as well as Atlas Venture. Looking into tools and diagnostics, obviously there was a lot of investment in here due to the COVID pandemic and companies trying to come up with their own way to either test or find ways to help with the vaccine. So there was a lot of investment in tools and diagnostics. Specifically, total investment was up 91% from 2019. And if we look at large deals, which were $100 million plus, these were all focused in the AI and machine learning for drug discovery platforms. Shifting now to health tech, this subsector set a new record from an investment standpoint, specifically at the Series A level. When we look at where were dollars invested, it was really in the provider operations, alternative care, as well as wellness and education. And before we get to exit trends, one slide that I don't have is on medical device. And what I want to say here is Series A was down year over year from 2019, but overall investment in medical device was up, which is a positive trend as we look to 2021. From a sector perspective as to where these dollars were being invested, imaging and cardiovascular, as well as neurology, drew the most investment. And then finally, looking at exit trends for 2020, the headline here is that we saw a record number of IPOs at record valuations. Very, very consistent with all the other trends that we saw from an investment standpoint, but this is where companies are seeing an exit, whether it's through IPO, M&A, or some other form, SPACs seem to be the buzzword these days. So a few points here just to make specifically on the biopharma side, we saw new peaks from an IPO perspective, pre-money valuations, as well as dollars raised at these IPOs. The market cap of VC-backed healthcare companies at IPO totaled close to $10 billion, which was 2 times what we saw in 2019. And in the DX tools subsectors, 6 of the 9 IPOs went public at $1 billion plus valuations. And like I said before, which I'll talk about a little bit later on in the 2021 outlook, SPACs are certainly a buzzword these days. I'm not the expert by all means, but I do have a few thoughts that I'm willing to share. Next, I'd like to talk about venture debt financing. And oddly enough, I was reading an article this morning in PitchBook, which talked about some of the trends that we've seen over the past few years from a venture debt perspective. And over the past 3 years, there's been more than $80 billion in loans and other debt products that has been originated for VC-backed companies. And more specifically, in 2020, biotech and pharma companies received more than $3 billion in loans. So that's a really good segue here. What I want to just talk about high level is what is venture debt financing, the benefits of venture debt, as well as some structure and considerations to think about, and if your company might be relevant or venture debt might be useful for you. So first, what is venture debt financing? It is a senior debt form of financing, sits on top of the capital stack. It really is a nice complement to equity financing, whether it's in connection with equity or shortly thereafter. There is a lot of payment flexibility in the form of usually only requiring interest payments for the first few years. And from a profile perspective, usually institutional VC backing is important, as well as Series A and beyond companies. And these are all cash burning company profiles as well. Next, what I want to talk about is benefits of venture debt. So it's less expensive than equity. And really what it does is it adds runway on the back end of a company's cash out profile. There's a lot of optionality for venture debt, as I mentioned in my opening around the venture debt markets. A lot of banks will provide venture debt, and there's certainly a lot of debt funds that will provide this offering. And so there's a lot of optionality for companies that are looking for venture debt. And the other thing that it really does is it's a relationship builder at the early stages. As banks and funds get to work with these companies at a much earlier stage, it just helps with better understanding the business and further supporting your business, that is, as you become more complex and need other products and services. And then shifting to structure and considerations. From a structure perspective, like I've said, it is a senior debt facility. There's typically an interest rate, which is based off of Wall Street Journal Prime, which nowadays is really attractive just based on where yields are. And there's typically a warrant and a covenant, or either or. And we usually base that off of certain inflection points of a company's business. Like I mentioned, there's interest-only flexibility, usually in the 12 to 18-month range, and the term is 3 to 5 years from inception. Now, when thinking about certain considerations for venture debt, a couple of things just to think about. You certainly want to make sure there's support for debt at the board level. We always have conversations when we're underwriting. We underwrite to the venture partners, the C-levels, as well as the business, but we always want to make sure that there is support for having debt in the business. You also want to be mindful not to over leverage your company. There's an appropriate amount of debt for a business based on certain inflection points and milestones, and you want to be really mindful of that. And you certainly want a partner that's going to work with you through the ups and downs, which as we know, in startup businesses, early stage companies, there's always going to be certain points in time where you need a little more flexibility. And so making sure that you have a partner that you can trust and work with is very, very important. Now looking at 2021 and the venture capital outlook, I certainly wish I had a crystal ball, and if I did, I probably wouldn't be doing this right now. But there's certainly a ton of optimism in the market. But what I would say is that there's also a lot of uncertainty. We don't know what's going to happen as we kind of work through everybody getting vaccinated over the next few months or so. And what I would say is the next, as I walk through these 4 sections, these are just my thoughts based on my research, as well as with speaking with VCs in the market, as well as CEOs and CFOs. But as we look to venture fundraising in general, coming off of a record year in 2020, my perspective is that venture funds will continue to raise at a really strong clip, but most likely in line with 2017, 18, and 19. As we shift to direct investment into portfolio companies, I would argue that biopharma will continue to see strong investment as companies will attract investment earlier and earlier. And companies like platform and oncology will always draw a lot of investment. From a health tech perspective, There'll be a continued focus in alternative care, so strong investment there as well. And DX and tools, despite vaccines on the horizon, what I've been speaking to a lot of companies on the diagnostic side is that there still is going to be a need for testing over the next few years or so. And so there will be some investment going into that sector as well. And from a device perspective, we could see a rebound in Series A. There were a lot of medtech companies that raised funds last year. And so they'll be looking to deploy that capital over the next few years. As we look at exits for life science and healthcare, we are entering IPO season right now. A lot of companies are looking to go public off of Q4 numbers. And so this is the time that we could potentially see a lot of activity in the IPO market. And SPACs, I'm certainly not an expert here, but what I will say from a data perspective, across all sectors since 2019, we've seen 99 SPACs that have been announced, and there are still 365 that are pending, which means that you have to find a target within 2 years. And so this is a very interesting time. It'll be fun to see what comes of both the SPAC, the IPO, as well as the M&A market. One thing that I would say, and again, my perspective here on a SPAC is making sure that if you are going through one, you realize that you will be a public company the day after you list and you find a target. So preparing your finance team accordingly is also really important. So I'll end where I started. 2020 was an unbelievable year. A lot of ups and downs, but what I'm really excited for is seeing where things shake out for this year. We're a quarter in. There's a lot of positive momentum, and I'm really excited to see where things go from a company formation as well as from an investment standpoint. Thanks again. My name is Skip Kelly, Managing Director for JP Morgan.